later on. So there was lots of people coming up with different ideas as to what would be in the autumn statement. The headlines were full of lots of tidbits and things that the Chancellor was definitely going to do. So for example, and it was received in different ways. It depends which political persuasion you are. Some people said it was a good budget. Some people said it was a bad autumn statement. So, for example, the Eye the next day led with tax burden to hit record high, even though there was a 2p cut for millions of people. The Daily Mail, though, said, let's hope it's just the start, painting a very positive picture as to what the results of it was going to be. I just want to say, just because somebody's put it in the chat, if you want to ask any questions as you go along, please put it in the chat. I'll try and pick them up. If not, I'll pick them up at the end, and we'll deal with them there. So there was a mixed reaction, and when you look at our papers, the Metro said happy NI year, talking about the national insurance cuts, and the Daily Mirror, on the other hand, saying, do they take us all for fools? So very much of a mixed package and mixed reaction to the autumn statement. And I noticed this morning there's a report in the Times that says that the Conservatives have got a 4-point increase in their share of the vote if there was an election called today. Still a massive gap between what they need in order to win the election. And I think it's going to be interesting to see in the days ahead as the packages take shape, to see what happens and what people's reaction to it will be. So enough about what people's reaction was. Let's just talk about some of the details. So inheritance tax, let's deal with inheritance tax. Probably about 3 or 4 weeks ago, there was lots of rumours circulating that the inheritance tax regime would be looked at and that there would be changes. Some people said that there was going to be a cut in inheritance tax. Other people said the allowances would go up. As this headline say, will inheritance tax go down? And this article was full of predictions, none of which incidentally happened, which I find vaguely amusing. But just suffice to say, on inheritance tax, nothing has changed. In fact, if you read the papers that were issued by the Treasury, inheritance tax is not even mentioned. Nothing. Sometimes it talks about the fact the thresholds might go up at the future, but there's nothing. So the nil rate band remains at £325,000. It's interesting that it's stayed at that since 2009. That's the last time it actually increased. And just imagine how the price of houses have increased since 2009. The residential nil rate band, that is at £175,000. So that means if you're a married couple, if you structure things correctly, you can pass on wealth of £1 million when you die, free of inheritance tax. And the threshold remains the same for the residential nil rate band. And most importantly, the inheritance tax rate remains at 40%. VAT. There wasn't a lot of mention of VAT in the Chancellor's statement, and there wasn't actually a lot of change and things published about VAT afterwards either. But there was just 3 things that I'll just mention in passing. One is that they're looking at the VAT treatment of taxis and private hire vehicles. Now, this follows a tax case back in July with Uber. Without getting into too much detail this morning, basically Uber were arguing that the taxi drivers were providing the services. So when you go and pay the taxi driver, you were paying the taxi driver, and therefore they didn't need to be registered for VAT. Whereas HMRC were arguing that Uber were the ones who were providing the services, and so your money went to Uber, and therefore VAT was due. It's a massive issue. It's been rumbling on, but HMRC are going to look at the whole issue, and they've said that they're going to try and find a way that is a workable and a sensible solution. I would imagine that it's going to be rambling on because it has lots of ramifications in other areas where you provide your services through some person, for example, Deliveroo, those sort of services. So HMRC are going to look at that. Perhaps more interestingly to some of us that are involved in charities, at the moment, if you have energy saving materials fitted to your house, things like solar panels, heat pumps. They can be installed free of VAT because they enjoy zero rating, and that runs to 2027, incidentally. Well, they've announced that what they will do is they will do two things. First of all, they will extend that scheme to include water source pumps. Apparently, a lot of installers have been saying that it would be of a great benefit if they had zero rating. And also what they're going to do is they're going to extend the relief not just to residential buildings, but to charitable buildings as well. So if you're a charity and you've got a building that you use for charitable purposes, so for example, a church, or some other charity, then you'll be able to have the energy saving products fitted free of VAT. And the final thing, which was well publicised in the days ahead in some of the more popular press, is that HMRC are going to remove VAT from ladies' women period pants. So moving on to income tax. On income tax, there isn't actually any particular changes of note. I've just taken the bands straight from the Treasury government documents. On income tax, the bands remain exactly the same. The legislation says that they're frozen until 2028, so it's a bit like what will be happening with has happened with inheritance tax. As people's earnings go up, a larger proportion of their income will be taxed at higher rates. And also the personal allowance has stayed frozen. The income tax rates, again, exactly the same. There was a lot of talk about that being reduced by a penny. They were 19% rate of income tax. Interestingly, none of the politicians are actually publicly saying that they would want to do that. The married allowance, that remains the same. But interestingly, if you're an older person, and you were born before the 6th of April 1935, you actually get an increase in the married couples allowance. As you can see from the slide here, the maximum amount that you can claim as a credit, that is, against your tax, so is 11,080 in the next tax year. The blind person's allowance, again, that's been uprated, but just to remind people, the dividend allowance, and this was announced probably about 18 months ago, that will be reducing from the 5th of April. So there was a time when you could receive up to £5,000 worth of dividends free of income tax. Then it was lowered to 2,000. In the tax year that we're now in, it's lowered to £1,000, and then it's lowered to £500. One of the reasons why they're doing this is because they know that people are abusing, so they say, the dividend regime, and they don't want to make it so lucrative for you to remunerate yourself in dividends. If you do the sums, because the dividend income tax rate is a lot lower than the basic rate of tax, dividends, if you're an owner managed business, is still the most tax efficient way to withdraw a remuneration from the business after you've used rent and interest. And generally, being a limited company is more tax efficient than being a sole trader or a partnership. However, the benefits are coming down all the time, and in some cases the benefits can only be a matter of £200 or £300. So that's the dividend allowance. To talk about benefit in kinds on cars. Now, the headline was that the benefit in kind rates were frozen for next year, and that is correct. They are frozen for next year. However, as I've pulled from this slide here, one thing to just note is, although they've been frozen for the 24-25 tax year, they start going up after that. So as you can see from the slide here, even for zero emission cars, and it's not so long ago that if you had a zero emission car, you didn't pay a benefit in kind at all. Well, now there is actually going to be an increase in the amount of income tax that you pay. So just to sort of earmark it, if you have a zero emission car, then the benefit in kind rate is 2% for next year, 3% for 25-26, 4% for 26-27. You can see there's a pattern coming here, and then another percentage for 27-28. They haven't publicised what they're going to be doing for 28, 29. As a general rule, they won't talk about that until probably about August, September time next year. But for all vehicles, there will be an increase in benefit in kind rate in the 25, 26 year, unless you're actually at the high end. Benefit in kind rates are actually capped at 37%. So if you have a very inefficient car with a large engine, actually your benefit in kind rate will stay at 37%. Although I would imagine that very few people are actually in practice having a car of that size as a benefit in kind. Moving to the other end of the scale, just up the scale, just to sort of highlight, when you look at there, the CO2 emissions for vehicles 70 74, their rates also are increasing. But interestingly, once you get down towards the bottom of the scale, then where you, so for example, from vehicles that emit more than 105 grams per kilometers, when you look at that, their rates are not going up so much in the next few years. So, for example, if you look at this slide here, then the vehicles for 105 grams, the rate is 26% in this tax year, 26% in the 24-25 year, 27% in the 25-26 year, and that stays at 27 for 26-27 and 27% for 27-28. So it's going to be a mixed picture for people with company cars, but particularly for those that have been used to having a very low benefits because they've got a car that doesn't emit a lot of emissions because they are electric or a very good hybrid vehicle. Those vehicles, they will see an increase in a benefit in kind every year after the end of after 24, 25. And so I think we just need to be aware of that and that issue. On national insurance, which was what caught the headlines. So national insurance is a tax that we pay. Historically, it went into a separate fund. It doesn't these days. It just goes into the general tax funds. And in terms of national insurance, the levels at which we pay national insurance, just as with income tax, are frozen, and therefore they stay the same as in previous years. So there's three limits we have to talk about with national insurance. One is the lower earnings limit. That remains at £6,396. I won't go into too much detail on that, but just to say that you have to have earnings of at least the lower earnings limit in order for your state pension record to be kept up to date, which is why that's relevant. The primary threshold, that's the level at which you as an employee start paying national insurance. That remains at 12,570, which is the same as when you start paying income tax. And then the upper earnings limit, that's when you stop paying the main rate of national insurance and you start paying 2%. That remains at £50,270. But what has changed is the national insurance rate. So I think most people, if they've listened to any commentary, will be well aware what has happened is that the national insurance rate for employees is going to be reduced by 2%. So up to the end of this year, or up to pay dates 5th of January to be precise, the national insurance rate will be 12%, which is what people are paying now on their earnings that they earn between 50,000 and 12,570. And then there's an early benefit in that from the 6th of January to the 5th of April, it will drop to 10%. Now, this is going to cause problems for payroll providers because they're going to have to change the software very quickly, get updates out to people. As I understand it, those who use the payroll products in the cloud, they're ready to go. So I read. But if you use a desktop payroll program or perhaps calculate it manually, and there are some people who still do, you need to be aware and ready to use the 10% rate from the 6th of January. It's also going to cause a hybrid rate for people who are directors, because directors are not, for national insurance purposes, are taxed on the year rather than a month-by-month basis. And so the rates of national insurance that they will pay will not be 12%, will not be 10%, it will be somewhere in between for the entire year. And then once you get above £50,000, that remains at 2%. There's no cut there. It's just that main band in between. So what does that actually mean? Well, I make no apology that I nicked this next slide from This Is Money, because they produced a nice little table. And what it shows is that the higher your salary, the higher the tax saving that you will have. So if you're on a salary of 30,000, there will be a saving of £348. If you're a salary of £50,000, then the saving is £748, and the maximum saving, which cuts in at £50,270, is £754. So that is going to be a saving for some people. They will see it in their pay packet and it will have an effect. Having said that, we do have to bear in mind that the personal allowances, the rates at which you pay income tax, and the various tax bands haven't changed, and therefore as people's earnings go up, there will be a larger share taken in the in income tax. I'll just pause there very quickly. Is there any questions on that so far? No? Okay, I'll carry on. So that's national insurance for employees. What about national insurance for employers? Well, that stays exactly the same. So the earnings below the secondary threshold, so the lower earnings, 0% as it is now, and above it, employers pay a flat rate of 13.8%. That will not change. There's also a saving, national insurance savings for those who are self-employed. Now, employees and self-employed people have always paid different national insurance rates. If you're self-employed, you have historically paid two types of national insurance. One is Class 2 national insurance, which was the equivalent to the old stamp that they had in the 1970s. I can remember my dad coming home and putting his stamp on his card. That is being scrapped. I have to say, I think it's caused problems of late. Sometimes the national insurance computer hasn't talked to the self-assessment computer, and we've had to spend hours trying to get the two computers talking to each other. So they scrapped the Class 2 national insurance for the majority of self-employed people. Now, there's going to be an oddity in the tax year that we're about to go into, the 24-25 tax year, because the way it works basically is if you have earnings below the small profits threshold, and that's £6,225, because you are small, you have historically been exempt from paying national insurance. That means that if your profits below £6,725, if you wanted to receive a credit against your state pension, you would have to pay national insurance on a voluntary basis. The rate at the moment is £3.45 a week. The rate for the next tax year is £370 tax a week. So interestingly, if you've got very low profits, £6,725 or lower, in order to have your state pension record kept up to date, you will next year have to still make Class 2 national insurance on a voluntary basis. If you have profits above £6,725, then in that case, these measures mean that you won't have to pay any Class 2 national insurance. And all the HMRC documents and Treasury documents say is they accept that this is an oddity of the way the system works. They accept it's not a good system, and they will be consulting on reforming the whole national insurance system for self-employed people in the months to come. Now, I have to say, last time they talked about consulting on national insurance, it became a bit of a minefield. And the reason for that is because you've got two systems trying to bring them together. The reason why self-employed people are paid less national insurance than employed people is, for example, self-employed people can't claim unemployment benefit or whatever it's called these days. Sickness pay, again, it's not so good as if you're an employee. So the reason why the rates were different. However, bearing in mind what this document says and what the government would like to do, and past governments have tried to do, it would be not surprise me if there would be a move to try and bring the national insurance rates for self-employed people and employed people into line. If self-employed people are paying 8% and employed people paying 10%, it's not too much to say, well, actually, I tell you what, let's just bring them in line at 9%. As I said, I don't know if that will happen. That's just something that's been mooted out there. But for self-employed people, there will be a Class 2 national insurance saving. Now, also Class 4 national insurance, which is the other national insurance for self-employed people, their rate, as I've already said, is 9%. It will drop to 8%. Now, because it's collected through self-assessment rather than through pay-as-you-earn, that can't be brought in early, so that will apply from the 5th of April 2024. So for profits earned for the 24-25 tax year, the national insurance rate will be 8%. So how much is the savings there? Well, not as much as been for somebody who's been employed. Remember on the previous slide, an employed person, the maximum saving was 700 odd quid. The maximum saving for a self-employed person is £556. And again, as your earnings go up, so the savings go up. Any questions before I move on to the next section? Okay. Right, capital gains. I can be very quick with capital gains. The capital gains tax rates, they are not changing. They are still remaining at the same. So capital gains tax rate is 10% if you're a basic rate taxpayer, 20% if you're a higher rate taxpayer. There is an 8% surcharge if you're selling a residential property. And can I please remind people on this call, because the number of times it's being missed, if you sell a residential property and there's tax to pay, the tax has to be declared and paid to HMRC within 60 days of the date of the sale. And there's very large penalties if you don't declare it on time. There's loads of penalties being issued, and it's something that easily gets missed. So the rates of capital gains tax, they're not changing, but what is changing is the annual exempt amount. So an individual can have a certain level of capital gains before they pay capital gains tax. It was 12,000 odd. The year that we're now in, it's £6,000, and next year it's going down to £3,000. Now, this probably means that in time to come, a lot of people will be making tax returns that they haven't done in the past. Some people would, and a lot of advisors and financial advisors will manage people's portfolios so that they have a gain each year, but it's within the capital gains limit. Well, when it was 12,000 odd, it was fairly easy to do. 6,000 probably okay. When it gets to 3,000, it's going to be a lot more difficult to try and manage the portfolio, and the tax savings from that management is going to be a lot lower. So although in the scheme of things it was said, oh, it's not going to cause too much issues, I think the ramification of that is going to be, there's another issue, which is with trusts. Trusts actually have an annual exempt amount that is no more than half of the limit. And as some people who know me know, I like trusts. But so the maximum trust annual exempt allowance next year will be £1,500. You're not going to be able to make much of a gain before a trust is going to start paying tax, have capital gains tax. Tax fraud. How are they going to pay for these savings? Well, the document talks about the fact that they're going to try and increase the tax take from tax fraud. Now, it's something that every autumn statement, every spring statement, every policy document you get, it always talks about how they're going to get tax from clamping down on tax fraud. And the problem is, actually, they don't know how much money has been lost through tax fraud because obviously it's not been declared. And so the figure is always a guess as to if we do this, then we might get money in. So what they're talking about this time, well, tax fraud at the moment, the maximum sentence you can get for being involved in tax fraud is 7 years. That is going to go up to 14 years. Now, I know there's other crimes that you could get sentenced for at the same time that would increase the the maximum sentence time, but for tax fraud, it's actually 7 years. It's going up to 14 years. Also, because there's lots of people out there selling lots of different schemes, most of which, in the opinion of HMRC and others, don't work. Actually, HMRC can't stop those schemes being sold. They had powers to fine them. And so now what they're doing is they're going on further and saying, look, if you're selling a tax scheme and we issue you with a stop notice, which is basically what HMRC can do, which is saying, so I come up with a scheme and I think it's great, HMRC think it doesn't, I can be issued with a stop notice. Well, up to now, I could be fined, but the fines were very small, surprisingly small, in fact. So if you charge somebody £1,000 for a tax scheme, you'd actually still be making a profit, even if you paid your fine. And some of the less scrupulous people in the industry have adopted the attitude that paying a fine is just a cost of doing business. Well, what HMRC are going to say, look, if we issue you a stop notice and you don't comply, not only are we going to fine you, we're going to be able to prosecute you. Also, they're going to have powers to apply to the court that says if you're involved in selling tax schemes and they don't work or the HMRC don't like it, they can actually apply to the court to disqualify you as being a director of a company or being involved as a person of significant control. And they reckon, and also the HMRC are going to be given, which I thought was a fairly small figure actually, a further £163 million to collect outstanding debts. The Treasury documents had a whole section on the level of debt that was outstanding to HMRC that hadn't been collected during the COVID period of time. Collection was put on hold, and so they're aiming to collect all those debts in, and they're going to give another £163 million to HMRC to do that. The CIS scheme. The CIS scheme is what contractors are involved in. So if you have a builder and he employs subcontractors to do the work for him, then that's the sort of work we're talking about here. Well, the CIS scheme has been around for years, and the basic principle of it is that the contractor will take tax off the subcontractor, so the subcontractor has had his tax paid for him. Subcontractors started to do a tax return, but it's almost a payment on account system, a bit like the employer taking tax off the employee. It works like that. Well, you can, and you can see my scheme, go to HMRC and saying, actually, I'm a good person. I make my returns on time. I pay my tax on time. I want to apply to have what's called gross status. That means that you're paid without that deduction, where they're making the rules a lot tougher. So they will be looking at future, not just are you doing your personal tax returns on time? Are you doing your VAT? They're saying, are you going to do your VAT returns on time? Are you paying your tax on time? Are companies and partnerships that you're involved in, are they paying their tax on? So they're going to try and toughen up. And basically, I think the message is that if you want to apply for gross status, you've got to make sure that your tax affairs are completely up to date all of the time. And not just that, what they're also saying is that they will be reviewing it more regularly. So you might have gross status as a subcontractor, but they may well be removed if you're late with your VAT returns. And that's expected to yield £5 billion a year over 5 years. So that is on tax avoidance. Moving on to additional information. So looking at the list of people here, we've got a mixture of people who are employees and employers, and we've also got people who are owner-managed businesses being paid through limited companies. These three changes will come in. They haven't actually said when they're going to come in. They need to work out how it's going to work in terms of software. But the three things to be aware of, particularly the first one, is that in future employers will need to report via the RTI system, that's the submissions that are made every month when an employee is paid, the contracted hours of an employee or the actual hours worked by the employee. Now, just as a bit of background to this, at the moment, when you set up an employee on a payroll system, you have to say what band of hours they're working, or whether it's regular or irregular. I think there's about 4 boxes you have to choose, but that doesn't actually give HMRC a lot of information. HMRC says that in order to have a good record of what people are working, they need to know how many hours a person has worked. Now, it doesn't take too much of a rocket scientist to know that if you know how much somebody's paid, which they know already, and the actual hours, they can work out if somebody's complying with the national minimum wage, for example. So HMRC say they need this information, and so it will be a requirement that your software transmits that information. The reason to flag it now is that if you've got somebody who is on a salary, who's contracted to do a certain number of hours, that's going to be fairly straightforward. You know what the contract says, you know how many hours a week or hours a month they're contracted to do. That will be easy for you to complete. It's the actual hours worked that's going to be more of a problem. Although I know people keep timesheets and some people are still paid by the hour, other people might be paid a flat rate, but their hours vary over a period of time. And it's that second category. Just make sure that you've got good record keeping so that comes in. The second one, dividend income, in future, and they did say they might try and get it onto next year's tax return, although there was something else that said that they couldn't do it for some reason. But coming in shortly, they will want separately on the self-assessment return to show the dividend income from any company that's what is called a close company. Now, for the purposes of this morning, it's basically an owner-managed business with less than 5 shareholders. So at the moment, if you look at the self-assessment return, all HMRC get is a box that says dividend income. In future, it will be dividend income from close companies, owner-managed businesses, and other dividend income. And also on that box, they will want you to record the percentage of the company that you own. Why do they want this information? Well, there's a lot of people out selling schemes at the moment that allow you to set up a business, and particularly if you are an employee, got say 3 or 4 employees, you say, actually, I'll tell you what, employees, rather than paying you by your salary, what we'll do is we'll pay you in dividends. So we'll set up an alphabet structure, A, B, C, and D share structure. And it's that sort of thing they're looking at. They're looking at avoidance. So where you have the typical structure that most of our clients have, where you have husband and wife, for example, being paid a basic salary and dividends thereafter, they're not worried, they're not concerned about that. That's not what this is aimed at. What they're worried about is people who are replacing their salary with dividends. And HMRC say they can't get this information any other way. They can't get it from Companies House, or the words were, it's difficult for them to get it from Companies House. And therefore, by recording it on your self-assessment return, they'll be able to choose people to look at individually. And then the final thing is they will mandate that it will be law for you to tell HMRC on the self-assessment return when you start and finish self-employed people. I find it vaguely amusing because I think most of us in the tax profession didn't actually realise that it wasn't a legal requirement to fill those boxes in the first place. There you go. Right, pensions. In terms of pensions, there was some changes made last year, and basically the legislation is going to put them into law now. So just to remind people, the lifetime allowance has been abolished. So at the moment there was talk about Labour voting it down, but it passed through Parliament. You can save what you like in a pension scheme without having to pay a charge if your savings go too high. It was the case that you could take 25% of the lifetime allowance from your pension pot free of tax. Well, if the lifetime allowance has been abolished, then obviously taking 25% of something that's been abolished is zero. So they have actually confirmed that the maximum that you could take from a pension scheme is tax-free is £268,275. It's still 25% of the funds it was before, but at least we have clarification of the amount. There's no changes in how much you can pay into pension. It's still £60,000 annual allowance a year, or if you're drawing on your pension already, the lower amount of £10,000. And the amount at which those allowances are tapered remain at £260,000. Moving on to R&D. I just want to try and illustrate the point here. So at the moment, if you are a company, and it's only companies this applies to, who are involved in research and development, you can claim additional tax reliefs. The idea is they want to encourage companies to be involved in R&D and reward them for it. There are, I've got this other question come in. Okay, thank you. Yeah, okay, that's just a note. Thank you very much. Right, okay, so R&D. So if you're involved in R&D, you can be rewarded for it if you're a limited company. There are two schemes. There's what I call the small company scheme, the large company scheme. Now, a small company can, in some cases, use a large company scheme, and I think we've got two clients who do, but there's different reasons for it. But basically, there's been two schemes about small company scheme and large company scheme. There's been differing rules. We won't worry about technicalities this morning, but one says you can claim subcontracted in some way. The other one says that you can claim subcontracted another way. And some allow you to claim a larger proportion of expenditure than others. So there's been these two schemes, and for a long time it's been leading to complexity, and that's going to be, sorry, I'm just clearing something was on my screen here. I do apologize. Right, that's gone off. Right, so those two schemes have been around for a number of years, and different rules, different complexity, and a lot of people have been saying this is daft. You don't know which scheme is best until you start doing the calculations. In some cases, you can be better off than others. So they are merging the two schemes together. Now, what has been happening over the last 3 or 4 years is the small company scheme has becoming less generous, and the large company scheme has becoming more generous. And what basically the change means is that a small company, the benefits are going to be reduced. Now, I'm just going to give a quick example. So a small company spends £100,000 on its R&D. At the moment, it can claim an additional tax relief of 86%. That's 86,000. So the additional tax relief at 19% is £16,340. If it's loss making, it can surrender that loss. And again, I won't talk through the mechanics of it, but basically it could surrender the loss from that R&D, and it could receive a tax benefit, a cash reward of £18,600. If you were a large company, you use what's called an above the line system. And the reasons why it's called above the line system is that you should be showing the credit in your accounts above the line. It's interesting because very often the R&D isn't calculated after calculated until after the accounts have been finalized, and that then means that you can't put it above the line, and technically speaking you should show it as a prior year adjustment. Those on the call accountants might like to think about that, but anyway, it's called the above line system. It's very simply you receive a credit from HMRC. So if you spend £100,000 as a large company on R&D, you receive a credit. The credit rate of this year, at this moment, and it will remain the case, is at 20%. So HMRC will send you a payment of £20,000, on which, of course, you have to pay tax. So they send you £20,000. It's like a grant, and if you're a taxpayer paying tax at 19%, you'd be left after paying 19% tax at £16,200, or if you're paying tax at 25%, you would be left with £15,000. And you can claim that as a cash repayment if you're loss making. What they're doing is they're bringing the two schemes together, and so I've just tried to make some comparisons there on this slide. So underneath the old scheme, small company would get £16,000 if they were profitable. Underneath the large scheme, £16,200. If the small company was paying 25% tax, underneath the small scheme, £21,500, £15,000. And the cash trade-in before £18,600, large company £16,200, which is coincidentally the 19% rate. Just summing that up, R&D for small companies still is going to be beneficial for them to make a claim. They're still going to be able to make a claim and it'd be better off. However, what I would say is you need to be aware of the fact that the benefits are going to be reduced for them. Okay, other reliefs, I've just mentioned them in passing. Often you talk about R&D reliefs. There are actually other reliefs available. If you're involved in orchestras, theatres, museums, and they're paying tax, they can claim a similar relief on some of their costs. If you're involved in making television programs or video games, their schemes are going to be revamped. And so they're taking the 6 schemes there are and bring them into 2. Full expensing. We're now on the home run. So full expensing, headline news. I think every news bulletin talks about full expensing, and so I thought I'd just spend about a couple of minutes talking about it. So if you're a business and you spend money on capital equipment, you can get tax relief for it. However, the amount of tax relief that you can get for that item varies depending upon what it is. There actually are, as you can see on the screen, several tax relief. So there's the annual investment allowance. There's the writing down allowance, which is basically a very small allowance, 18% for most per year for most people, 8% on certain assets. 100% first year allowance. If you buy a brand new electric car, you can claim the 100% first year allowance. Structures and building allowance, that's what you claim on a building or a structure. The super deduction, that came in temporarily, and that ceased to be with us from the 31st of March last year. 50% first year allowance, again, there's certain items you can claim that on. And then finally, the full expensing, which was brought in. Now, just as a bit of context to tell you what the problem is. Most businesses will claim the annual investment allowance when they buy plant and equipment. So if you are let's say, for example, you are a builder and you go and buy a digger. You buy that digger, and when we do the accounts, we would claim the annual investment allowance, which is 100% write-off for the expense for most equipment. Now, what that means is that if you spend £100,000 and you're paying the 25% rate of corporation tax, your tax saving is 25%. So annual investment allowance is very good because it reduces the tax bill quite significantly. However, the annual investment allowance is limited to £1 million in a financial year. The limit has gone up and down over a period of time, but currently it's at £1 million. Large companies, so in fact, Treasury documents refer to BT, Bosch, and the utility companies. They are all saying that that's fine, but they spend a lot more than £1 million on assets. So if they spend £1 million on plant equipment in a year, fine, immediate tax relief. After that, they're into that writing down allowance, which can be 18% or per year or 8%, and significant difference. So full expensing is to try and deal with that problem. So it's going to be an expensive tax relief. Again, all the various documents say it's worth about £10 billion a year to the taxpayer. So that's how much it's costing the exchequer. But what it means is that it's effectively annual investment allowance, but writing off with no limit. So what it means is that if you spend £1 million on assets, we'll claim the annual investment allowance. If you did spend more than £1 million, and I think in reality it's pretty unlikely, but if you did, then we could claim the full expense allowance. But it does come with a catch. So for starters, it can only be claimed on new equipment. It can only be claimed by limited companies, incidentally. But it only can be claimed on new equipment. It can't be second-hand. The asset can't be used for leasing, although the legislation says it will be consulted on whether or not to extend it to leasing companies. If the plant and equipment is what's called special rate expenditure, so that's things like electrical installations, solar panels and so on, you still won't be able to claim 100% of the cost. It'll only be 50%. And things like cars and buildings do not qualify for the full expense. They will be the normal rules. And the other catch is that there will be a clawback when the asset is sold. So if you buy the digger and then 2 years later sell it, you might have got, you might have bought it and it cost you £100,000, but when you sell it and you sell it for £50,000, you'll have to pay tax back to HMRC on the £50,000 proceeds. Freeports, I mentioned this because we have a Freeport just down the road from us in Felixstowe and Harwich and Stowmarket. Unfortunately, I will notice the slide has got a bit pixelated. I do apologise, but I have actually put the slide up. So just to sort of highlight if the Freeport area that we have is in Felixstowe, down by Felixstowe Docks, over in Harwich, over in Stowmarket. As you go by the A14, you'll see that they're building, that's a Freeport area, and also the other Freeport area for tax purposes is down by the A12, but has not yet been built. So they're the Freeport's tax areas. Now there's also innovation centres, and there's so for example the centre at Marsham that's now been nominated an innovation centre, part of the Freeport scheme. But for tax purposes, there's only 3 areas local, and they're very specific to being in Felixstowe Docks, Harwich Docks, and also the area Astral Park. I mentioned that just to highlight it in case you hear it. You have to actually be present. You have to be on those sites in order to benefit from them. But the tax reliefs have been extended for another 5 years. And the reason they've done that is because one of the tax reliefs, for example, is if you put a building up on one of these port areas, you get an immediate tax relief rather than having to claim relief over several years. You get an immediate tax relief. So what they've done is they said, actually, I tell you what, the release would be running out shortly, so we're going to extend them for another years until 2031. Okay. So the final ones are just looking at, just mopping up business rates. It was mentioned, I'll just mention it in passing. If you're retail or in the hospitality sector or leisure business, your 75% business rate discount will continue for another year. However, just to highlight that the multiple that you will be using to calculate the rates bill will be going up by 6.6%. So although they will have a significant reduction that can continue to enjoy the discount, there will actually be an increase in the rates that they pay. There's a lot of commentators saying that now this 75% discount has been with us for so long, it looks as if it's probably here to stay, because how do you suddenly go from a 75% discount to no discount? It'll be interesting to see how that is coped with in future statements and budgets. And small businesses, their rates are not going up. The multiplier is staying exactly the same at 49p per pound. Making Tax Digital. So Making Tax Digital is a system where reports have to be made of income on a quarterly basis via a computer system. It has been postponed. It was really talked about probably about 6 or 7 years ago, and I've talked about it quite a bit to clients. And anyway, it's been hands confirmed that it is going to be coming in. Back in last March, they said this is our aim. It has been confirmed now. It is now in legislation. Doesn't mean to say they couldn't scrap it, because I noticed that both ICAW and CAT are still lobbying for it to be scrapped, and as told HMRC in no uncertain terms. But anyway, it is with us. It will be with us. So what will happen is from April 2026, if you're a landlord or a sole trader, you will have to report to HMRC digitally if your turnover or your rents received are £50,000 a year. Okay, so what that means is that if you fall in that category, from April 26, every quarter you will have to make a quarterly report using your software. If you don't keep your records currently on software, if you're still keeping records manually, they will have to be kept on a computerized records. Now, where I think it will be a bigger issue is with landlords. We have several clients who are landlords, and they might have a rental agent. So typically they'll have a rental agent. The rental agent will send them the check every month with a statement that says this is the rent received. Those sort of people will have to have those records kept in some computer form, and they will have to transmit those figures to HMRC on a quarterly basis. So although it's not coming in, it's something for that sort of people to start thinking about. I've just had a question come in. I have a limited company and property owned as individuals. Does that mean we can treat the two entities separately? Yes, that's correct. So just to explain, the limits apply. This making tax digital limits do not apply at the moment for companies. Originally, companies were going to be 2023, and obviously it's not here. Companies are seen to be too difficult at the moment, and so therefore all that HMRC is saying is they will look at companies, but they want to get sole traders and partnerships onto the system to start off with. So that's the first thing to say. Limited companies are not included. When you look at turnover, you look at your personal turnover. So if you're a husband and wife and you're renting out a unit and the total rent is £50,000, you will not be covered by making tax digital because your share of the rent is £25,000. Does that? So hopefully that answers the question. If it doesn't, by all means come back to me later on. So the limit applies to your personal limit. So it's your share of the rental income and turnover. So yes, landlords as individuals will be covered if their rental income is £50,000. Same thing if you're a sole trader. And if you're a sole trader and your rental income is £20,000 and your sales is £30,000, those two are combined to get to your £50,000. Okay. I think the other thing is start looking and thinking about it now. So when we get to April 26, you're all set up. We can help you. We've got computer programs that we recommend. Excel is still compliant as long as you can transmit to the figures to HMRC on a compliant thing. The limit's coming down. I apologise, I can see that my slide is slightly wrong there. So the limit's coming down in 2027 to £30,000. So 2026, £50,000 or over. 2027, £30,000 or over. In the budget, in the statement that was published on the day, HMRC said that they accept that it will be cumbersome for small traders, and therefore they will not introduce it for people with a turnover less than £30,000. But then they contradicted themselves by saying, but we remain committed to bring them in at some point in the future. I think the message is, and what will probably happen is that they'll hope that that it works well, and therefore they'll bring people in. So there will be a change you need to be aware of. You'll need to work with us for those of our clients to do that. Partnerships, at the moment, partnerships are difficult for HMRC. They've trialed it. Apparently the trials didn't go very well, and therefore they have said, we will bring partnerships into making tax digital. We remain committed to it, but we accept that there needs to be a lot more work on it. Also, as a part of these changes, what they're saying is from 6th of April 24, so that's not just on the road, you can draw up your rental accounts on a cash basis. Now, what they're getting at, and also your sole trader accounts on a cash basis. So at the moment, there's lots of things where we have to adjust accounts for accruals, prepayments, stock, and so on. What they're saying is from April 24, the default is whatever size your business is, you can just use the cash basis. So cash in, cash out. First of all, it's not always advantageous. There are cases where if you, for example, you owe a lot of people at the end of the year because you suppliers, it might be better for you to pay on the accruals basis. Also, your accounts don't necessarily make a lot of sense. So just because you can do it doesn't necessarily say it's going to be a good idea. Okay, and then the final slides, just wrapping up. ISA limits will remain the same. So the limits are £20,000 that you can put into an ISA in a year. But what will change is that they will say that you will now be able to open multiple ISAs across providers in the same tax year, as long as you do not exceed the limits. I was a bit puzzled about this because I wasn't aware that it was a real life problem, but apparently Martin Lewis tells us that it's that people like to have £5,000 with one provider and £5,000 with another provider, and how can they get the best rates in a tax year if they have to stick with the same provider in the same tax year? Which I sort of understand, but whether it's actually a real problem or not, I don't know. But anyway, as from April, you'll be able to have put £5,000 with, let's say, Barclays, £5,000 with HSBC, and so on and so forth. You won't have to have all of your £20,000 with one provider in the same tax year. Incidentally, on that front, yes, we've been asked, can an individual put £10,000 in a cash ISA and in SS? And yes, that is correct. Basically the limit is split as it is now. The limit, you know, what you can do, the flexibility as you have now, but it's just purely and simply that you can use multiple providers to spread that across. I think it will be interesting to see how the market actually, because it copes with that structure. Incidentally, what I did mention when I was talking about pensions is that one of the things they're going to be doing is introducing legislation that requires employers to pay into the employee's pension pot of their choosing. So at the moment, if you go and work for employer A, they might use NEST, and therefore you have a pension pot with NEST, and you go to employer B and they might use People's Pension, and employer C might use Legal and General. Well, what they're going to be doing is they're going to be bringing legislation that says, as an employee, I can say to my employer, I want you to pay in to my pension scheme. Now they're going to be also putting digital, they're also going to be apparently simplifying the way that pension contributions are paid. The idea is that as an employer, I will pay it to one central pot, and that the computer system will automatically take it amongst the various providers. We wait and see how that will work in practice. But the idea is that as an individual, I just have one pension pot with a pension company of my choosing, and that can be my pension pot for life. So if I change jobs, that will stay with me. I take it to my next job. They haven't got a time scale for what it is. So they haven't got a time scale for when that comes in. So I'm just clearing the question down. There we go. Right. And then finally, the last two slides very quickly. Vehicle exercise duty, just to highlight, if you on the road fund license, for most people, if with a modern car, the road fund license goes up by 5% upwards. I say that because some is going up by 6%, some by 7%. Air passenger duties, there's some increases there, and all the other environmental taxes, plastic packing tax, landfill taxes, they are all going up. It's interesting that it was hardly mentioned during the autumn statements that these taxes were going up. And then electric charging, this wasn't part of the autumn statement, but I'm just mentioning it because HMRC published some guidance, and I just want to clarify it because it may affect people. So there has been a bit of an issue, a bit of question mark about what happens if, as an employer, I provide an employee with an electric car. So it's a company electric car. The employee drives that car, charges it at the office. That would be completely free of any benefit in kind. No problem with that. Electric charging at premises, that's not a benefit in kind issue. But what happens if the employee takes a company car at home at night and then charges up at home? Now, the tax profession for a long time have said there is no tax benefit if an employer reimburses the cost of charging it. It will not be a taxable benefit. However, HMRC, in all their guidance and all their documents, said, no, we don't agree. If an employer makes a payment to an employee, it is taxable. This has been going on for a fairly long time. HMRC have long last caved in, and they said, yes, we agree with you. The legislation quite clearly says that if the employer reimburses the cost of charging the electric vehicle at home, it will not be a taxable benefit. So just to be clear, this is where the employer provides an electric car to the employee rather than the car being owned by the employee. Now, if the employee owns the electric car, he can claim a mileage rate from his employer for the miles that he travels. So that's just sort of to highlight that that HMRC have at long last changed. Now, if you go to HMRC's guidance and their documents, they have not yet updated all of it. It is now completely inconsistent and a mess. So just be aware, HMRC have publicly said there is no benefit in kind and there is no issues. So that brings me to the end. It's 9:31. I apologise for going over the time. If there's any questions, I will hang on for a couple of minutes. If not, please send me an email. After this is finished, we will put a recording to our YouTube channel, and I will send a copy of the slides around to everybody who was on the call. So thank you very much for joining me. I'm just checking the question box. I can't see there's any questions, so I shall bring this to a conclusion. So thank you very much for being with us.